Hello, passive investors. Welcome to Passive Pockets presented by Equity Trust. I'm your host, Paul Shannon. A critical part of investing is knowing who you're investing in. So today we're going to meet Andy Weiner from RockStep Capital. Let's jump into it. Andy, welcome and thanks for supporting the Passive Pockets community. How are you today?
Paul, excited to be here. Thanks.
Awesome. Well, hey, to start, tell us a little bit about your company, RockStep Capital, and what type of real estate you focus on.
Yeah, RockStep Capital is a shopping center investment company. We're based in Houston. We invest in shopping centers in secondary and tertiary markets around the country. We currently have properties in 11 states, three types of properties: grocery anchored, non-grocery anchored open air centers, often called neighborhood or power centers. And then we also invest in enclosed malls. We currently have about 100 employees and we're vertically integrated. We do everything in-house: acquisitions, dispositions, leasing, property management, reporting, construction management, underwriting. Everything is done in-house.
Excellent. Very impressive. And from what I understand and talking with you in the past, you kind of grew up in this space, right? And you've been in the retail world for most of your life, really. How did you first get into this type of business?
I was born into retail, Paul. So my grandfather started a clothing store company in Houston, and we ended up with 159 stores. So it became a regional retailer, and I ran operations for the company. The stores were the size of a TJ Maxx, about 20,000 square feet, and I ran operations. I ran store operations, I ran real estate, so I learned about leasing and shopping centers, HR, logistics, systems, finance. So I really grew up in retail and became a student of retail. I am a retailer by background. And then in 1997, 28 years ago, I started RockStep and have been doing shopping center investing since that time.
It's really interesting because you've kind of seen both sides of it as the lessor and the lessee, right? How had that experience coming up in the retail space helped you come to the conclusion that you wanted to start RockStep, and what advantages does that give you today?
I love real estate and I love retail. And so this was the perfect combination. Shopping centers is the combination of both. The advantage that experience I had as a retailer, it gives me, is that it helps me understand our tenants. Okay. How strong are they? How do they deal with merchandise? So when we buy a shopping center or we investigate a shopping center, I'll walk inside every store and I'll walk the far corners of each store, and I'll look at how do they merchandise? How much inventory per foot do they have? What kind of planograms are they? Are they able to merchandise the corner and the walls as well as the entrance? In other words, how's their operations? How's their management? How are their systems? How often are they turning their merchandise? And generally, you can tell the strength of a retailer by walking the store, okay? Is merchandise picked up? How is lighting? What kind of fixturing do they have? How are they replenishing? I've walked into thousands and thousands of stores. I've probably been in 500 Walmarts. I've probably been in 400 malls, maybe more than that. I've been into several thousand cities and secondary and tertiary markets. I mean, I've been doing this a long time. After a while, you get a sense of judgment about the strength of a retailer. And then you have to study retailers. You have to look at their balance sheet. I go to the Goldman Sachs Retail Conference every year. So I'm looking at, what is the management like? What is their executive team like? How do they think about store metrics? Okay. In other words, what kind of investment do they make in a store? What kind of return on investment do they get for that store? And what is the viability of that company long term? And is their balance sheet strong enough to be in business 10, 20, 30 years? So the answer is it helps understand how to invest in shopping centers and basically how to manage risk.
I love that because you could be new in the space and you could get access to a lot of data and be very quantitative in your approach. But in your case, with that background, you've got a great qualitative experience to kind of make sense of the data that you're analyzing and add an extra layer of experience, and it's invaluable. So I'm sure, though, as you've come up in the space and you've matured into where you are today, there's been some mistakes along the way. Can you share with us one that you had, and specifically that you remember?
In our family business, the clothing store, we were not operating our inventory in a way to effectively compete against Walmart. And I wasn't in charge of the inventory. We weren't marking our goods down in a strategic cadence to stay profitable and stay competitive against Walmart. So I learned a lot about how important it is to have an amazing inventory and marketing strategy, and how you have to be able to turn your goods. And then here at RockStep, market selection has been something that we have gotten better at. So in other words, we focus today on secondary, tertiary markets that have essential drivers: tourism, major military, major university, Fortune 1000 companies, major hospital district, something that makes sure that demography, that population, is stable and growing. A while ago, we would choose some markets that didn't have the right characteristics, and we've learned from that.
So, what would you say at this point? Let's take the other end of the spectrum. What's the biggest factor in your success in real estate to date? Is it taking those lessons learned and pivoting and moving in a different direction, or is there something overarching that's kind of led you to the point you're at today?
The biggest factor for success, and I think there's some multiple ones. Obviously, you get better and better and better and better and better every day. You're always learning from your problems and your opportunities, and I think we've gotten really good. But I think the biggest factor, Paul, to our success is how we have built a team of high performance people, okay, a high performance team. And I mention this because I wrote an owner's manual for our company about 10, 11 years ago, where I came up with 25 rules of behavior that are very, very specific about how all of us at RockStep, we have about 100 employees, need to engage with each other, how we manage conflict, how we build trust, and we call them Rock Steps. That's our name. And I am passionate about enforcing these rules of behavior and creating rituals around these behaviors so that we don't have jerks at our company, that we practice A+ness, rock step number 2, that we do the right thing always, rock step number 1, that we speak straight, rock step number 8, rock step 24, keep family first, rock step 25, have fun, and that we live these rules to build a team of people who are really, really good at what they do. And we've got people from Blackstone and Brookfield and CBL and some of the big public REITs who want to be part of a team. And that team is what we have been building, and I'm most proud of. You asked the success factors. It's the rock steps. It's building a set of behaviors and enforcing that set of behaviors and ritualizing and using the language of that behavior to build trust, resolve conflict, and build a team. And we're required to live by these rules, Paul, with our investors, our tenants, our communities, our professionals, our lenders, everybody, and they can hold us accountable. Okay. And so anybody can go online, rockstep.com, about RockStep, and you can see each of these rock steps. And I did a video actually of every rock step and what it means.
I love that answer. Creating that corporate culture sort of, and having everybody be aligned in that sense.
Not the corporate culture of the 6 things on a wall, but actionable behaviors that are ritualized in the company. That's the difference. Okay. And I live these, I hope. I enforce these, I hope. I cry about these. If anybody wants to manipulate me, just tell me they love the rock steps and I'll start crying. Okay. So it's important. It is important.
Important indeed. And then also surrounding yourself with people that have, high integrity and have skill sets that you don't necessarily have. I know that's been a big success factor to me, is just being in the room and being connected and knowing who to call. Folks that do things a little bit differently than me or have skill sets that I don't have elevated me to the next level. That's fantastic. Let's shift gears a little bit here and talk about personal portfolio. Do you own any real estate outside of RockStep? Are you involved in any syndications as a limited partner, or just direct ownership of any other types of real estate?
I started doing syndications in 2010, I think, or right after the GFC. Before that, I have partnerships where me and my ex-wife, shopping centers that are not part of those partnerships. Everything we've done since effectively the GFC has been in partnerships that have third-party investors, and I put my own capital and I have family members involved in every deal.
So we talk a lot about financial freedom, quote unquote, in the passive pockets community, and it means something different, I think, to a lot different people, right? So what does it mean to you when you hear that phrase?
From an investor perspective, financial freedom is to have a diversified portfolio of income producing properties, not investments that produce something 5 or 10 years down the road if they hit. What I like about the retail sector is that it is the sector in commercial real estate that has yield. Okay. Unlike multifamily or an industrial, oftentimes you'll have negative leverage. Today, we're buying a grocery anchored center at a 9 cap or 9% yield. We're borrowing at 7%. So by adding debt, we're giving more cash to our equity. And then we're also in the enclosed mall space buying deals at 13 or 16 cap and borrowing at 7.5%. So I believe that from an investor's perspective, as much as possible of an alternative real estate investment should come from just cash flow, not back end bet that you're going to buy it for X and sell it for 130% of X in 5 years, but that there's actually income, a good portion, 30, 40, 50% of your income during that 5 or 6 year hold comes from cash. Nothing's wrong with cash. We believe in boring cash.
I'm with you on that one, 100%. My philosophy as well. So I will echo that sentiment. All right, Andy, let's wrap it up here. Last question for you. What is the most important thing passive investors and syndications should learn to do to maximize their success in this type of investing?
I think an investor investing in passive real estate should diversify. And let's use the term of buying one asset, one investment versus buying five, or coming into a fund. A fund gives you automatic diversification. If you're dealing with 5 or 6 investments, on average, one will underperform, 1 or 2 should overperform, and the rest should kind of do what the targeted returns are. We target high teens IRR, okay? And so I think it's very important for somebody either to diversify through a fund or commit to 4 or 5 chunks of investment. And then the second thing is, I think it's important to diversify into alternative sectors in real estate. Most people start, and I understand why, in some kind of residential investment, usually multifamily. But there are other sectors. Right now, retail has yield that offer diversification. And so my recommendation is multiple sectors and multiple investments.
Well, Andy, this has been great. I appreciate you giving us some insights and a look behind the curtain. Thanks for coming on today.
Hey, thank you so much, Paul.
That wraps up this interview with Andy. Be sure to check out our YouTube channel and subscribe to our podcast for more great insights in the world of syndications. Thanks for tuning in, and as always, happy investing.